In a note yesterday, BTIG chief equity strategist Julian Emanuel predicted the Fed will cut rates twice this year. We're calling it our big call today, Julian. When was I on Fast Money? A couple weeks ago, I think. You had a big call that night. Do you just make big calls constantly? Your big call that night was that 3,000 on the S&P could be low for this year, and you were very, very bullish. 2 weeks ago, so far, so maybe it was 3 weeks ago, so far so good on the averages. But now this is another big call. Why, if things are so good, if you were expecting the averages to surge, why do we need a rate cut?
Well, the first thing is we have to disabuse ourselves of the notion that it is completely tied into stock prices. Because if you look at the past, the Fed has often started the cutting cycle while the markets were at or near the highs. The important thing is to realize that the tendency has been to start cutting around 5-6 months after the last hike. And essentially, the way we see the economy developing is, you look at there's recession probabilities have risen because of the damage that was done in the fourth quarter, to the point where actually it's only been 2 times where you haven't had a recession end up developing. And so we think it's a form of insurance that they're going to take out.
So the recession fears, is it self-fulfilling because we got nervous, or did the Fed actually overshoot and slow the economy more than was necessary?
Well, no, I don't think they have slowed the economy more than necessary.
Did they overshoot?
We did not think that they should have hiked in December. Look, there was a confluence of circumstances that caused the kinds of dislocations that we saw. But fast forward, essentially part of the problem, and Mohamed talked about this earlier, is the rest of the world we're dependent on to a certain extent, and Europe continues to be slow.
But what do we do for ammunition? That's what everybody's argument is, that we have no dry powder for next time there is an actual slowdown. If we need to cut 3, 4, 5 times, we're going to be at 0, and we're going to be going negative.
No, you won't be at 0. You're actually, the midpoint right now is 2 3/8. You've got plenty of room.
Plenty of room at 2
The Wall
3.
Street Journal today says Neel Kashkari still doesn't want to see them cutting rates just yet. And he was one of the Fed officials who was actually most in favor of them not raising rates. He was on the argument of not doing that. So if you've got guys like him who are in the camp of let's not cut yet.
Let me pile on. I mean, if I was a Fed official, I suspect the central view is we've already bought insurance. That's what we did in March by guiding very dovish, and it worked. Yields have come down. The stock market has recovered. Q4 is way back. So why do you want us to buy more insurance at this point?
Well, we're not saying at this point. What we're talking about is the evolution over the next 6 months. And part of what's different from the Fed's message is a desire for a rate of inflation that's higher than where we've been. The last 20 years has averaged 1.7 on core PCE, and the Fed is talking all of a sudden about tolerating rates of inflation above the 2% target to get there. And that, to us, is one of the ways where you can get there.
But if they look at Europe today, the inflation number undershot again. Even though we have negative interest rates, even though we had a much bigger QE, and maybe it's structural. Maybe you don't think the Fed says at some point we've done what we can do and now it's up to somebody else, or do you think they'll just continue to chase this?
They haven't gotten there yet. I mean, in our view, attempting a goal of over 2% may be misguided, because the past tells you that when you've been over 2% inflation, it has not been good for asset markets. Be that as it may, that's their point of view. And again, going back to it, there aren't that many levers that the Fed can push. And certainly the ability to affect Europe is really marginal at best.
So in this next 6 months, your call is really about slowing from the rest of the world and spill over here, rather than something breaking in the U.S. economy.
That's right. That's absolutely right. And it's insurance. And not only is insurance, but there's an element of not politicizing, because if they need to cut, you want to be done well before the election next year.
And what happens to the yield curve under this scenario?
We think you steepen from here. We do. We think that, if anything, if they're able to get inflation expectations starting to move higher, that will translate into higher, longer-term yields.
So we can continue to have a pretty good year GDP-wise, and this is an inflation call?
No, this is essentially an insurance call.
What's GDP going to be this year?
We think it's going to be north of 2%.
North of 2.5 or north of 2?
No, north of 2.
So
2.2 is our number.
Lower than last.
Yeah, yeah, absolutely. And look, we
Still
all
doesn't seem
know,
like rate cutting. I mean, that was, people say 2 is all we're really capable of right now with productivity and with population.
well, I'll leave it with this whole idea of, you know, the 4 most dangerous words in money and investing are it's different this time. And if you look at the progression of cutting cycles after hiking cycles, the last time you waited more than a year to start cutting rates was 2007.
It's just a pretty anemic hiking cycle, though. We're all conditioned to believe that it just feels like we're still at historically low levels.
And
I mean,
we
it's
are.
definitely non-consent. I don't think people hear that they're going to be rate cuts and they think you're crazy. You've been smoking something at these levels, especially with stock market and the economy and everything else. I could only see it as an inflation. You know, I could see why not keep rates low if there's no inflation. Let the good times roll if you're not worried about inflation. But I just don't know whether I see the economy in a negative place, which would allow for them to cut. Otherwise,
Well,
the criticism, and it's coming already. It's like, Larry, what are you talking about? You just, out of one side of your mouth, you just said how great things are. And on the other side of your mouth, you just said we need to cut rates. That makes you think Larry doesn't really believe that the economy is as strong as he's indicating. Or
Well,
the president.
their numbers-
Or the president
They should
said.
actually be cutting rates, and he's just saying that because the president.
But if
wants
it's inflation, I could see it, because then it's...
Their number's 3%. And, you know, that's sort of their point of view. You know, our number is 2.2, but the point is the Fed has made it very clear that it actually wants higher inflation. And there are only so many ways that you can actually achieve that.
Powell doing it either, really. Because then it looks like he's being political and
But that's what I would think.
bending
It makes
to
them look like
Trump's
they've made a
wishes.
mistake, and I think
And
that's
bending
a lot to ask.
and being, you know, listening to, you know, being at the beck and call of Donald Trump, which he doesn't.
I think you have very recent precedent for that exact change of course. You know, Chairman Powell has shown that he does have some flexibility, and obviously he's going to have to fight the political fight during his entire tenure, but he changed course in January when the facts changed. We think the evolution is going to push him in that direction.